Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guys Show. Today, let's talk about how annuities can reduce your taxes legally. So we all hate taxes, myself included. I hate them, but there are ways to reduce them, and we're going to talk about that. So with annuity contracts, you're buying these for contractual guarantees. You can buy them for lifetime income, which I sell a lot of these for that. And then, of course, if you're looking just for market risk protection, there are MYGAs, which are fixed annuities. They pay fixed rates like a CD. And then you have indexed annuities, which, of course, they give you market-like growth, but not quite as much as the market. It's sometimes half of it, but they give you full market protection. And so those are great for that. But let's talk about how to reduce taxes. And we're going to use an income rider because they pay the most income generally when you're looking at highest annual income. Okay. So I'm going to share my screen. I'm going to show you how this works. If you are looking for an annuity for yourself though, I would say just go to my website, check out my calculators, and you'll see what the highest payouts are there. And then of course, if you want my help purchasing one, I'd love to help you. There is a link right there on my website, and there's a link below this video for that. Looking at my screen, you will notice that I've got someone in Texas. They're 60 years old. They've got $650,000 and they want to invest it into an annuity and they want to start income in 5 years. Now, this could be completely different for you, and that's why I always tell people go to my website and use my calculators. So you'll see here the income's pretty good. I mean, I'm getting $71,000, $72,000 depending on the carrier I choose to work with. And Equitrust is good. So is F&G. If you want A-rated, stick with F&G. But you got all the other options. You got Nationwide. Nationwide's good too. They're A+. Okay, so you got North American, Midland, American Equity, lots of good companies. I work with all these companies. So let's go back up and say, all right, well, if we do F&G, okay, so again, we want to reduce taxes legally. Okay, we're going to talk about that. So if I just have this in a traditional IRA, okay, a traditional IRA, I'm taxed as ordinary income. So if I want to reduce my taxes in this, I'm not going to be able to. Okay, it's $71,500 and I'm being taxed. And it's, if I've got extra pension income on top of that, then, that's going to be included with that. So it's anything that comes out of a traditional IRA bucket is going to be taxed as ordinary income. So unless you convert it to a Roth, then it's not going to be tax-free. So that's why I do have a lot of clients that will convert to Roth after purchasing an annuity because they want tax-free income. You just have to think about the implications and the costs for doing that. And, is it worth it? Because the break-even age a lot of times for that is in your 80s. So anyway, so if we take this $71,500 and we have to pay taxes on it, if I'm in the 20% tax bracket, I'm paying $14,000 a year in taxes on this. Okay. Not very fun. Now, if it is a Roth, okay, I'll go back here and I'll show you. If I want to do a Roth conversion, Nationwide Peak will allow me to do it. Okay. I could do a full Roth conversion, which is expensive if I want to do it all at once, or if I want to spread it out, because again, I'm waiting 5 years to take income, then I'm going to do it with a carrier that allows me to do that. And Midland and American Equity allows me to do that. So if I were to choose the highest one, it'd be Midland. And I might just decide to do, spread out over 5 years, and I'm going to do a certain amount each year, and, and I'll convert that. And then at the end of 5 years, I'll take my $69,000, but now it's tax-free. That is a great way to keep your taxes low. If you got, other pension money coming in that's worth $40,000, you're only taxed on that because this is not seen as income because it is in a Roth bucket. So if you got an annuity inside of a Roth bucket, then anything that comes out of that bucket is tax-free. And this is guaranteed for life. Okay, this never ends. So that's pretty nice. Never-ending tax-free income. So we can see here. See that? It's great. So, all right, now let's go back and we'll say, okay, but what if I don't have a Roth? Or what if I don't want to convert my traditional IRA to a Roth? What then? Okay, are there ways to bring it down? Yes, there are. So let me show you that. So same number, no difference. Let me pull this right back up here. And that's Midland. Let's look at F&G. Okay, so F&G getting $71,500. Let's pretend, okay, that this is non-qualified money. This is money I've already been taxed on. Okay, I pulled this out of my brokerage or out of cash, but it's already been taxed. And so, of course, you're not going to be taxed on non-qualified funds. Okay, the income is exactly the same, but there's a difference. You will have earnings during that time, but maybe you won't. So let's take a look. If you have zero earnings, which is not likely because they're giving you some of the S&P 500. They're not going to give you very much though. If you look down here, They're capping it at like 3%. So F&G doesn't give you a ton. There are other carriers that'll give you more, but for this case, their focus is on highest lifetime contractual income. Okay, so going back up to here, if we had no growth, then this $71,500 is going to be tax-free, 100%, because they're giving you back your $650,000. Okay, that was already taxed. That's tax-free. So during these years, you're going to enjoy a lot of income that's not being taxed. But guess what? After that is used up, that $71,500 becomes fully taxable. Okay, so that's when it's fully 100% benefit from the company. Now let's go look at a most likely scenario of growth. What will probably happen is, and you can see the growth is not much. It grows to like maybe $683,000. So you got what? $33,000 in earnings that you've got up to this point. They're going to give you $71,000 in income, and when it's a non-qualified annuity, it's taxed as a LIFO, last in, first out. So you look at that and say, okay, well, if I'm going to be, I'm going to be given back my interest first, right? Because that was the last in. So that's the first out of that $71,500. Okay. So again, I've got growth here of $33,000. So let's do the math here. So $33,000. So I've got $71,500 subtract $33,000. Okay. So $38,000 of that $71,500 payment will be tax-free. So I'm going to get some that's earnings and some that is completely tax-free because it's from my principal. Now, what happens in the next year if it's zero? Let's say the market's down, I don't get any growth. Well, guess what? The next year, the $71,500 is completely tax-free again. Now, what if the next year I do earn some money? Maybe it's more than 3%. Maybe they raise their cap, okay? And maybe I earn 5%, okay? Now I get $25,000, let's say, of earnings that year. So at that point, it's, what is it? It's $71,000 minus $25,000 of earnings. So I get like roughly $46,500 in tax-free income because they're returning that portion after giving me the $25,000 in earnings. See how that works? So this is how it most likely will happen is over this time period, your earnings would be less and less because you'll have a lower balance earning that. Okay. And when you have a lower balance earning that, there would be less earnings. That would be a portion of that $71,500. And so there will be a lot of years where it's more and more of it is tax-free. But eventually it will all become taxable because they will have given you back, they will have returned that original premium to you tax-free. And then of course you're liable for taxes after that. So that is a legal way to do it. And I have someone right now I'm helping, like literally we talked yesterday and he has a high income this year and he's going to retire this year. But he's got a lot of bonuses and stuff and he's all taxable. And he's like, I want this immediate annuity, but it'll push me to like 37%. I don't want to be in a high tax bracket. And so he's like, I'll just start my income next year. But the income is virtually the same next year. He might as well take the income this year and he's going to get an extra $40,000. But he still doesn't want to be pushing that high tax bracket because it'll put him in a high tax bracket with all of his other investments, everything else that he's dealing with. But it's a non-qualified annuity. So guess what? He's buying a non-qualified annuity and he's putting the money into this. And what's great about it is this will, if it does earn interest, it's not going to be credited to his account until next year. Okay. Which means if he starts this as an immediate income like he wants to, $5,000 every single month, that's all going to be return of premium for the next 8 months, right? So he's going to get that $40,000 tax-free because it's seen as return of premium. There has been no earnings credited yet to that account. Now, next year, that'll be different, but next year he won't have his other income that raises him into the high tax bracket. It'll be lower, and then he'll have this that's still coming out tax, some of it's tax-free, some of it's not, but maybe he'll have $30,000 in earnings, right? The year after that. Then he'll pay taxes on that because that has to come out first. And then of course, he won't get taxed on the money that comes out after that for the rest of his lifetime payment because that is return of principal again. You see? So that's how that works. And then he might have a bad year where the market doesn't do anything. And then that year, all that money that comes out to him is tax-free. So see how that works? It's a great way to take income earlier with non-qualified funds and not be taxed on it, especially in the first year, because you won't see any earnings until the first anniversary, okay? So the earnings, they will measure the index from point to point, and then they'll credit the account at the end of the first anniversary. So it's just a good hack to know. But if you're looking to purchase an annuity, I'd love to help you. Book a call. There's a link below this video. I'd love to help. And of course, go to my website. There's actually a link below this for my website, or you can go to johnstevenson.com and you'll be able to see what's available. Check the annuity calculators and then book a call with me if you're ready. So I'm happy to help. I'm not going to try to sell you, but I will show you everything that's available. So if you like the video, make sure you like, subscribe, share, comment below. I'm happy to help, and we'll see you next time.